Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to learn about velocity banking. And before we get into that, I just want to mention that these reactions that I've been doing have been getting so popular, right? So people are not just coming to this channel for velocity banking, but they want me to react to other videos. And I got a good watch time just from this video. And somebody left a comment here. Okay, let me just show you. Explain your line of credit as main account thing you mentioned. And, when we deal with broke people, I talk about, hey, if you know how to manage your cash flow, then and you have debt, then learning how to manage your debt will be much easier. And then, I might be a little snarky and just say, just look, watch all the other videos on my YouTube channel, but I have to be a little bit sensitive that, sometimes the people will find this channel through YouTube recommended feed. But, um, what is this? Explain this line of credit as main account thing. Well, it's velocity banking, right? So we're going to go over that today, and let's go ahead and do this. So here we have an income of $6,000, expenses of $5,945, and $54 left over in savings. And this is a debt payoff strategy, right? So here we got a ton of debt. When we do our expense breakdowns, we got to eliminate our credit cards, our auto loan, two student loans, and a mortgage. So how many debts do we have? One, two, three, four, five, six, seven, eight, nine. Nine debts. We're going to get rid of all of them. And we have our general expenses that we always have to pay for every month: food, gas, insurance. And understand the way that the bank makes money is that they don't want you to pay off any debt early, whether it's a credit card or an auto loan, right? I heard a statistic from various sources that most people carry balances on their credit cards. I don't know how true it is. Do I have balances on my credit cards? Never. Because it's all, if I do carry a balance, it's all transferred to the line of credit, which is what we're going to do today. So we're going to do this thing called velocity banking. So what is velocity banking? All it is a debt payoff strategy where you throw all your money into debt with the help of a line of credit. And here's the secret to it. Number one is that you're not going to save any money. Okay. Number two is that you're going to use this thing called a line of credit as your main operating account. You see the comment here where it's like, what is this main account thing you mentioned? This is velocity banking. And so, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So this is my line of credit, my home equity line of credit, $280,000. What does that mean? I go to the bank's website, I click a button, they'll dump $280,000 into my checking account at a 7.5% interest rate, right? That's velocity banking. It's really simple. And then we're going to have an idea called cash flow, which is very similar to savings. But once we move some of that debt into a line of credit, then this number should increase, right? And, some of you might be like, who would give you a free and clear line of credit where you're not using it at all in the very beginning? And the answer is nobody, because, here's a secret to getting credit. And I'm a guy who has over 500, no, is it 500? $579,000 in lines of credit. See, I get so much credit that I don't even know how much I have anymore. I can't remember. I got to look it up. But it's $579,000 in lines of credit. And here's the secret to getting credit is that banks don't lend money to people who need it. Okay? And you might be like, that makes no sense. But from the bank's perspective, it makes perfect sense because people who need money are a giant risk, and the bank's mission is to lower their risk. Okay. So if you need money, or if you want to get loan or credit loans, lines of credit, you got to get it before you ever need it, right? Because that's who banks lend to. Didn't know that, did you? Or some of you did, because I'm the velocity banking crack dealer, and I'm here to supply you with my velocity banking crack. All right, so let's go ahead and move these credit cards into the line of credit. We'll assume we have a free and clear $100,000 line of credit. A credit card technically is a line of credit, but it has some restrictions, right? You can't use it to pay another credit card or a loan or a line of credit, because they don't want you to do that with the credit card. But the line of credit, they don't care. Isn't that amazing? They don't really care. That's why you need all of them. I got like 20, 19 credit cards. All right, so that's $62,000 of credit card debt. So what we're gonna do is move that 62,000 into the line of credit. It's like a balance transfer. You're actually dumping 62,000 in your checking or savings, and then paying off your credit cards. and then this all goes to 0, and then wha-blam, look at this. This is where the clickbait dramatic, part of the video happens, where we literally go from $54, right, to $2,059.71, okay? And then what we're gonna do as a final step, which is put your entire $6,000 paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again, and this is gonna be at an 8% interest rate, even though my home equity line of credit, okay, is actually 7.5. And then to get the next month's balance, you get these two columns, you add them up here, and then you subtract your cash flow, which is 2059.71. Remember, we went from $54 to $2,000, right, in an instant because we had a line of credit. Okay. And the whole secret to this is that we're dumping all of our money into debt and we have free access to our money. That's the whole secret of velocity banking. I mean, think about why most people never pay off their debts early. It's because banks like you to segregate your income, meaning when you get paid, you're just making minimum payments on everything. You're splitting your income into a gajillion different places, and we're putting all of our money into one place. Now, if you want to calculate the interest, it's based on the average daily balance, multiply by the interest rate, and then you divide by 12. Okay, so we're going to go ahead and copy and paste that. Copy and paste, and then after every single month, ooh, did I screw up here? How did I skip that? All right, after every single month, right, we're gonna, I think I screwed up. Did I screw up? Let me try this again. All right, so after every single month, right, the balance will eventually go down to 0, and in this case, it'll be a little bit less than 3 years, so 34 months, right, 34 months. And then we paid off $62,000 in debt. See how the answer is just right in front of your face if you just explore the YouTube channel and then click the other videos to see an explanation of this, but no worries, no worries. I'm not making fun of you. I just want you to join my little secret cult. All right, so now it's 34 months. We paid off the debt, and then in right here, right, month 34, 34, 34, 34, okay, we have the current balances of all of our loans. Now, why are we starting off with this auto loan rather than maybe the 6% student loan? Well, the reason is, right? The reason is that this auto loan, when we pay it off and move into a line of credit, gives us the most amount of cash flow, right? So you take a look here, $9,000 for $300 of cash flow, or I could tackle on, I don't know, 34 grand for only $500 of cash flow. Which one gives me more bang for my buck? This one will, so I'm going to take this one out, okay? And I'm going to go here, right? Bang for my buck, Control V, and I'm going to do this, and then this is going to be plus 9158.73, or 9158, okay? And then so now, okay, so now, this goes to 0, and then our cash flow is $2,400, $2,400. And I'm going to do this, Control Paste, and then this is going to be 2428.04, and then wow, 38 months paid off. All right, 38 months, it's paid off, and then 38 months, 62 plus 20, that's 82K. So just 4 more months, and then now we got to tackle on the student loans. All right, so let's go to 82 months. So this is 0. Wait, did I say 82? That's not right. 38 months, so 38, 38, 38, right? So we're gonna tackle on this. Wait, actually, this is a 3% loan. I screwed up. So 15K, 15K, 3% loan. So why are we? Actually, this is the order is wrong, but the idea is right. Why are we gonna focus on the 6% student loan with a bigger balance than the 15%? Because some people might say, well, just do the debt snowball, right? Again, we're always thinking about bang for a buck in terms of cash flow. So if we pay this 33 grand, we're going to get the $499 back, and that's more bang for a buck than the 10 grand, right? And if you ever see a difference in the interest rates, like, 8% line of credit and we'll say 3% loan. Safest way to pay it off is what we call the chunking method, which is very resistant, not foolproof resistant, but very resistant to the interest rate. Okay, so I'm gonna go ahead and pay this 33 grand off, and then we're gonna chunk it, meaning we're just gonna move a small amount to the line of credit. And so what does that mean? I'm just gonna move $6,000 of the loan. Let's move $6,000 plus 6,000. And then I'll move it to the line of credit. How long did it take to pay off that 6 grand? 2 months, right? And then luckily we have this velocity banking calculator that is essentially like a cheat sheet, right? $6,000 of income. How much in expenses? Let's go ahead and calculate this. So it's everything except for the loan we're trying to pay off. So it's actually this. Whoopsie. Copy. All right. So I'm going to do this. And hold on. So 3072.37. All right, so 3072.37. Whoopsie. 3072.37. We're going to do a $6,000 chunk. What's the original balance? This is a 10-year loan. What's the payment amount? 499.59. 499.59. The interest rate is 6%. And what's the original balance? It's 45,000. Okay, and the current balance is, go right here, 33,539.77. 33,539.77. 1 year to pay off that 33 grand left. Awesome. So, whoopsie, let me go back here. So let me do this. Let me do this. So I actually switched these up. So give me 1 second to fix this. Ooh, sneezing during recording. All right. So now this is going to be 0. And then we just do it again, right? So now in 1 year, so that's 38 plus 12. That's 50 months. All right. So 50 months. And then it'd be 82 plus 15, right? 82 plus 15, which is 97K. 97K. All right, so $97,000 is paid off. 97,000. Okay, now we got to look here. So this is 0. So now it's 50, 50, right? So we do the same thing here with this one. So I'm going to put in the details here. What's our expenses now? It's 30. It's actually just this. My bad. It's 2927.53. So 2927.53. So it's everything except for the loan you're trying to pay off. So I think this is a 3%. And then we just got to do this payment amount. The payment amount is going to be 144.84. 144.84. And then the original balance is, what's the original balance? It is 45. No, it's 15 grand. Yeah, 15 grand. Okay, 15 grand. My bad. And then what's the current balance? It is 9290.67. 9290.67 should be very fast. 0.3 months. Look at that. Love it. So 0.3 months, we're going to pay it off. All right. And then I'm just going to go back here and then be 50 plus 0.3 times 12. It's going to be 54 months. All right. And then this is going to be 97 plus 45. 142K. Okay. And then now we just got to re-update this at 54 months, right? So 54, this is now 0. And then we just do this right here. So this is now a 30-year loan. Whoopsie. 30-year loan. All right. And this is going to be a $2,000 of income. And then the payment amount is 927.53. 927.53. And then the interest rate is 3%. 3%. And then what's the original balance? Original balance is 220. 220,000. And then the current balance is 198,202. 54.39. Okay. Yeah, 54 months. 198,202.39. So 198,202.39. Wablam, 4.5 years. Okay. So now I just do this and I'm going to do 54 divided by 12 plus 4.5. That is 9 years and we are debt free completely. That's a bigly debt that we paid off all in 9 years. And I should do a tally. Okay. So 142 plus 220. So 142 is 220. That's $362,000 of debt. And now we got rich people problems. $4,000 a month that we don't even know what to do with anymore because we're so rich. All right. So good for us. All right. So if you want to see why I say highly resistant to the interest rate, if I change this to a 30% line of credit, 30, look at it. Same payoff time and how much more in interest did I pay? 4 grand more. So a lot of times people like freak out, and I've done comparisons of 0% interest and 8%. And, a lot of people are saying, oh my goodness, you should never do that. And again, I would never pay a 0% loan with a 8% line of credit. But what sometimes people get all crazy and think like it's the end of the world. Now, if you do a first lien credit, line of credit, home equity line of credit, look at that. You pay so much more. You pay more than the 30% credit card. People didn't know that, right? I'm the one teaching you this. And you know where I learned this from? I learned this from Renatus. Okay, that's where I learned this from. So if you want to learn not only this, but other stuff as well, click the Google form link below, right? It's my plug so that I can make some more money selling educational products and, give me the money, right? All right. Well, that's it for today, folks. This is Korean Atlanta Mentorship. Have a great day, and I'll see you on the next video.